Welcome to this McKinsey Global Institute virtual event.
Hello, everyone, and welcome. I'm Olivia White, a senior partner at McKinsey and a director at the McKinsey Global Institute. So today we're going to discuss a new report, which is called the FDI Shakeup, how foreign direct investment today may shape industry and trade tomorrow. So over time, foreign direct investment has transformed industries from oil to semiconductors to electronics, and we'll talk about a bunch of that today. But the topic of the report is the shifts that we see in greenfield FDI today and how that may shape industry and trade tomorrow. And that's the shakeup that we refer to. So today we're going to kick things off with a short presentation by my co-authors on this report, Tiago Devesa and Jeongmin Seong. And we're going to move to a panel discussion that I'm very excited about. I'll be moderating, and joining us are Chris Miller, who's a professor at Tufts and author of Chip War, Vivek Ramachandran, who heads Global Trade Solutions at HSBC, and Daniel Yergin, who is the vice chairman of S&P Global and the author of one of my favorite books, The Prize, and many others. And I'll give a little bit more of an introduction for each of them right before we start. But for now, Jeongmin, over to you.
Thanks a lot, Olivia. So this page shows a collection of MGI's recent research on global connections from trade to FDI, and feel free to download them and read them when you get bored this weekend. And I promise they are more interesting than they sound. And let me start with the trade in the next page. So as you can see, there are a lot of colors on this chart, and we'll need to use a bit of artistic talent to make sense of it. So on the horizontal axis, you can see different geographies. And on the vertical axis, you can see the categories of goods being traded. The blue boxes mean that a region is a net exporter. The red boxes mean a net importer. And the redder the color, the more that region is dependent on foreign inputs. And as you can see in this chart, there are a lot of red boxes everywhere. So despite the popular narrative about decoupling, our view is that the world remains deeply interconnected and no region is an island. But what is really going on in the next page? Our view is that what we are seeing right now is not an outright decoupling, but rather a reconfiguration of the global trade network. And we looked at two dimensions of reconfiguration. Left-hand side is the geographic distance of trade, basically measuring how far goods travel on average physically. And that geographic distance has been rising steadily. So despite all the talk about reshoring or onshoring, that is not really happening on a global scale. Right-hand side is another dimension, which we call a geopolitical distance of trade, basically measuring how aligned trading nations are in terms of their geopolitical position. And we quantified this geopolitical position based upon UN voting patterns over the past 20 years and applied them to trade values. And since 2017, that geopolitical distance has been falling by about 7%. So it looks like friendshoring is indeed happening. Then let's zoom into this geopolitical distance and apply the same concept on the FDI, which is in the next page. And what we found out was that the geopolitical distance of FDI actually has been falling twice as fast as trade. And in other words, FDI flows seems to be changing faster than physical trade network. So FDI can be a really interesting leading indicator for us to watch. Then let's discuss what is driving this change from sectoral perspective and geographic perspective. Next page is a sectoral perspective. We see a big reconfiguration. So about 75% of FDI is now flowing into what we call future shaping sectors and also the resources that power them. And that is up from 50% before. So the greenish color here represents the future shaping sector. So basically AI infrastructure, that is mostly data center, advanced manufacturing, which includes semiconductors and EVs and batteries. And these future shaping sectors need critical minerals and a lot of energy. So FDI also went to those sectors as well, which is bullish areas in this chart. So these are big numbers, but then what do actual deals actually look like, and will they lead to a big impact? Tiago has the answer. Tiago?
Thank you, Jeongmin. So essentially, when we look at what multinationals are doing vis-a-vis future shaping industries, we talk about what we call the rise of megadeals. So what does this mean? Megadeals are projects that are worth over $1 billion a pop, and they now make up about 50% of all announced greenfield FDI, up from 30% on the pre-pandemic period. In other words, 1% of deals, 50% of the value. So what's going on here? When we think of future shaping industries, if you think of chips, if you think of AI, if you think of EVs, these are highly capital intensive. They rely on the most advanced technologies, and they are often winner takes most industries. So multinationals that really want to play a role in these industries are locked into what we call an investment race. They have to invest larger and larger amounts if they want to be placed in the industries that are really going to shape the future of our economy. To give you a little bit of color there, think of the TSMC project in Arizona in the US, $165 billion. That is by far the largest FDI project ever announced. Gigafactories to produce the batteries that go into electric vehicles, these are multi-billion-dollar endeavors as well. Data centers, as they went from dozen megawatt scale to 100 megawatt scale, and now we are seeing the first gigawatt size campuses being announced, are now multi-billion-dollar endeavors too, often cracking over $10 billion for a single deal. A very similar dynamic is playing in the world of energy, as well as we'll discuss later in projects such as LNG and offshore oil and gas. Now, this is the point of the conversation where you might be wondering, well, but are these things really going to come true? Are projects of this massive size actually going to come to fruition? And essentially what we've seen is that history is our friend, and it gives us clues. Around 60 to 80% of deals historically have actually come to fruition. So yes, a couple of these might get canceled, put on hold, but this is signal, this is not noise. And so when you factor in then what these projects, when they come to fruition, can do to the global economy, you can essentially wind forward the clock and go from announcement to when they break ground to when they actually bring productive capacity online and study what does that actually do to the industries of the future. So let's start on the left-hand side with leading edge semiconductors. When these projects come online, they could add about 60% extra capacity to this industry. You know, it's not nothing, it's pretty substantial. But what's really interesting is where this capacity is coming. Leading edge semiconductors today, 90% of them come from Korea and Taiwan. Where the FDI projects are going, however, is everywhere else. So when you look at capacity outside of the big hubs today, you can look at the 5 times increase on capacity today. A similar story plays out in batteries, where today China accounts for over 80% of capacity, over 90% for some chemistries. But where FDI is going is increasing by 5 times capacity outside of China, be it in Europe, be it in Southeast Asia, be it in the US. And finally, a similar story for data centers, a doubling of capacity outside of US and China could be afoot. Let's double click into the case of semiconductors just to give you a little bit of color of what this looks like. So this is a little bit of spot the 7 differences between the left and the right side images. On the left, you have the pre-pandemic period. On the right, you have the post-pandemic period. The size of each bubble, which represents an economy, is telling you how much FDI has this economy attracted in chips, and the arrows is telling you who were the partners. So I'm not going to ask you to strain your eyes too much, but on the left, you kind of see this big red bubble. That's China. So emblematic of the old story of FDI, if you will, China attracted the most FDI into chips. Post-pandemic, China is almost nowhere to be seen. And what instead you see is this big bubble of the United States, attracting by far the most FDI into chips of any economy, coming from where? Well, precisely from Taiwan and Korea, the players that actually hold the leading edge of these technologies. So this is emblematic of a lot of the dynamics of FDI, which is less money going into China and more money flowing around what we call advanced, somewhat aligned economies. If you zoom out now, and let's not just talk about chips, let's not just talk about the United States, let's talk about the global economy. What do we really see? Well, let me tell you a story in 3 acts. In red, you see China and Russia. These are the places where FDI has quasi dried up. So drops of more than 60, 70% compared to the pre-pandemic period into these economies. You then have a tier Latin America, Sub-Saharan Africa, India, Southeast Asia of primarily emerging economies that have seen growth in their capacity to attract FDI, but it's somewhat moderate growth. A lot of these economies have also seen somewhat of a concentrated attraction of FDI. So in Latin America and Sub-Saharan Africa, a lot of energy projects. In India and Southeast Asia, a lot of advanced manufacturing projects. Which then takes us to the stronger blue economies, Europe, the Middle East, Advanced Asia, which are really the places that have attracted the fastest growing FDI globally. What I haven't mentioned yet is the United States. The United States has been, since 2022, by far the runaway leader in FDI attraction, essentially doubling its attraction of new FDI projects since before the pandemic. And 2025, very early days, initial signals, but a further doubling that we've seen in the beginning of this year in annualized terms. So when we put all of these pieces together, we can ask again, why do we care about FDI? We care about these FDI projects because they're basically giving us a window into the future of the global economy. The projects that get announced today will come to fruition in a couple of years, and they can change the trade corridors that run our world. They can change the competitiveness of different countries. And they're also telling us something pretty profound about how multinationals are shifting their strategies in terms of how they think about supply and demand, and the new business ecosystems that might arise from what we call the industries of the future. So this is our research in 80 days, if you will. And now I'm going to hand over to my colleague, Olivia White, who's going to moderate a great panel for you.
Thanks, Tiago. And I'm really excited to introduce our panel. And I don't normally use notes for these things, but for these folks, I'm going to make sure I get everything I need to say. So I'm joined first by Chris Miller, who's a professor, as I said a little earlier, at the Tufts, at the Fletcher School at Tufts University. He's also a non-resident senior fellow at American Enterprise Institute. He wrote, as I mentioned, the book Chip War, The Fight for the World's Most Critical Technology, which came out in 2022. And here's where I need my notes. So it was a New York Times bestseller. It won the Financial Times Business Book of the Year. It won the Arthur Ross Book Award and the IEEE 2024 History Prize. And it was also featured on both New Yorker and Economist Best of 2022 lists. So welcome, Chris. It's wonderful to have you with us.
Thank you.
Vivek, yeah, good to have you. Vivek Ramachandran heads Global Trade Solutions at HSBC, and he's also a PhD economist. He has really deep practical expertise in trade and investment, supply chain finance, digital innovation, all of these things, and leads today a team of over 5,000 trade professionals across 50 countries. Vivek, welcome.
Pleasure.
And then last, but very decidedly not least, Daniel Yergin is a Pulitzer Prize-winning authority on energy and geopolitics and economics, and has done a lot of work also on mining, which we'll talk about today too. He's the vice chairman of S&P Global, and he's also the author of several acclaimed books. So, for example, The New Map, Energy, Climate, and the Clash of Nations, which has been described as a masterclass on how the world works, and also, as I mentioned a little bit earlier, the book, The Prize. So welcome all of you. It's a real pleasure to have you here. Before I start, I would urge and ask you, the audience, to feel free to ask questions using the Q&A tab, and you can find it on the right side of your screen. We'll leave about 10 minutes at the end of the conversation explicitly for questions, but feel free to ask questions as we go, and we'll start to interweave them into the conversation, even in the main part of today's panel. So all of that said, as Tiago mentioned, history is our friend, and history sets a really interesting and important context for a lot of what's happening today. And so then maybe I start with you, and perhaps you can talk about the role that FDI has played from its very inception in the development of the oil industry and what that teaches us about today.
Well, thank you. As I was listening to Jeongmin and Tiago speaking, I found myself thinking that what are some of the drivers of today were the drivers of what was the first great wave of foreign direct investment, which was the oil and gas industry. It was driven by technology, by economic opportunity, and by governments. The US government was pushing companies to go overseas. And out of that, of course, it became a foundation of the world economy. At the time, the internal combustion engine was a new innovation. Aviation was a new innovation. But I was also thinking as they were talking that multinational investment has always come politically charged with controversy. I went back to a book I remembered from my graduate student days, published in 1977, called Storm Over the Multinationals. And at that point, this great tension was about US multinationals going overseas, particularly to Europe. And it had this wonderful quote: the multinational enterprise is widely seen as threatening the autonomy of the nation state. That was 1977. Where we are today, I think, at least the way I think about it, we're kind of been at the end of what we might call the second age of globalization, about a 3.5 decade period of easy globalization in which supply chains were seen as about efficiency, we're not seen as strategic, and we're in a more complicated era, whereas the undercurrent of what both Jeongmin and Tiago were talking about is, of course, there's political and set reasons for that dramatic shift in FDI back into the United States. It isn't just happening because people say, "Hey, I haven't invested in the U.S. before." So I think we have to keep in context the kind of penumbra of strategic concerns around it as we see the world's supply chains really being, as you all just suggested, reshaped.
So keeping with your theme, at least of history, but how that teaches us something about today, Chris, as you write about extremely effectively in chip wars, of course, the semiconductor industry, FDI in that industry has been an important factor for quite some time. It's not just today. What's useful to know about history, even as one surveys current events?
Well, I think there's some aspects of modern supply chains that date back many decades or even centuries, as Dan noted, but some are actually relatively new historically. And I think manufactured supply chains, especially for complex manufactured goods, do have new dynamics that we didn't see historically, where products can't be produced in a single country. They need to be produced with components from multiple different countries. And so take a smartphone or a computer, you have that dynamic. And that is something that didn't really happen more than half a century ago. And it's been intensified over the last couple of decades in what Dan, I think, rightly called the easy period of globalization. And what we're seeing now, and we've been seeing it develop over the last 10 years or so, is the clash between the geopolitical conflicts, which are intensifying, and a world of complex manufactured supply chains, which was basically forged before this intensifying geopolitical dynamic. And companies are, I think, having to reorient their thinking, as Dan said, away from solely focusing on efficiency to also considering the political and regulatory dynamics, which are increasingly shaping their decision-making.
So Vivek, as we transition into the world that Chris is talking about today, how do you see it from your really rather bird's eye view?
And there's never been, I think, from my perspective, a more interesting time to be in trade. I joke about at dinner parties, for the first time, people want to hear about what I do, because everyone wants to understand how the world trade ecosystem works. I think, as both Chris and Daniel said, supply chains evolved over decades with one singular objective, which is cost minimization. And that's changed quite dramatically. There are two big themes reshaping what our clients and corporates are talking about. The first, unsurprisingly, is tariffs. Global mercantile trade, give or take, is $25 trillion of exports that move around the world. And around $5 trillion of that makes its way into the US, either directly into the US or part of a US supply chain. And the US effective tariff rate going from 2.5% to close to 20% today has fundamentally required companies to revisit what they do, where they do it. I think your research captures a lot of it, but a lot of corporates are putting off strategic investment decisions till they have a little bit more clarity. So I do think we'll see an increase in manufacturing FDI that companies are holding back on. The second big theme reshaping supply chains in the world is what your research picks up very effectively is services. Services is give or take 70-75% of most advanced economies, but it's only 25% to trade. And everything that you're seeing in terms of chips and AI and semiconductors and arguably the energy that goes all around it is going to be reshaping the services economy. And that's where companies are making big bets. But at this point in time, most companies are re-evaluating options, but a lot of decisions are still on hold.
So let me ask a question, and I'll direct it to either or both of you, Dan and Chris, about as we sort of set the scene, as we talk about the way that trade itself is shifting goods, services, the goods that underpin services. How do you think about the role of actual domestic actors and domestic investors alongside this whole conversation about cross-border FDI?
Chris, why don't you go first and then I'll follow up.
Well, I think that domestic investors are trying to make sense of the same themes that international investors have to, because we're seeing subsidies, tariffs, regulatory dynamics change the expected return on investment, whether you're investing in one country or another. And so even if investment is being made within one country, it has to take into account these international dynamics, because they're often critically important in all of the spheres that we've discussed thus far in shaping the likely return profiles, because they benefit certain players and lock out others. And again, this is something new that especially domestic investors haven't had to think about in the past. But now, whether it's energy or technology, it's front and center in any investment committee meeting.
And I'll add to that. I was thinking one of the books I wrote was called The Commanding Heights, The Battle Between State and Market. And that was a period when there was greater and greater confidence in markets and the decision makers by markets. We're basically moving back into a commanding heights again, where governments are calling more of the shots in terms of economic decisions. And I think it's hard for many companies to ascertain, because it isn't a smooth process. It goes in one direction, goes in another direction. And I think that goes to what both Chris and what Vivek said, that a lot of people are actually standing on the side while they try and figure out what's going to happen over a period of 5 or 7 years, because these investments are made are for a much longer term than 1 or 2 political terms. So I think it's tough for decision makers who've worked by the playbooks of market decision making and the playbook of globalization in this new era, which is, it didn't start with the most recent administration. It started before that, but obviously it's taken on a complexity that wasn't there before. It's sort of complex decision making to go with complex manufacturing.
It's actually quite interesting, Daniel, because if you look at investment coming out of China, just not very long ago, the Belt and Road Initiative was very state-driven, and now a lot of it is private enterprise-driven. Ironically, and to the opposite extreme, you actually have a lot of investment decisions coming out of the West now that actually is sponsored by the state or state coordinated. So you're seeing a slight difference in trends than what you would have historically predicted.
Yeah, in fact, Vivek, two things on that. I think today, the announcement of the U.S. government investing in a mining project in Australia, we would not have expected to have seen that. And Vivek, a question for you. I've heard it said that some of the investment out of China elsewhere is also a desire to sort of move into a different political realm and have assets more diversified rather than just in China.
Some of it is diversification. Some of it is, I think, supply chains are actually ironically getting longer instead of shorter. So supply chains are getting longer and less transparent. Because if you look at the value added component of what's made its way into the US, that hasn't gone down, while exports obviously from China have. So some of it is complexity in supply chains have increased to diversify things like the impact of tariffs in individual countries.
Now, one of the motivations behind the research was supply chains are shifting now, but if we look at foreign direct investment today, it will tell us yet more about how supply chains might shift in future. Chris, Tiago showed a quite striking before and after picture of FDI going into semiconductors. And that wasn't even the leading edge specific chart. That was all semiconductors. I guess my question for you is, first, did that chart surprise you, or you're like, oh no, that's old news? But also, how do you think things might shift given the way that money is flowing today?
Well, I did think it was a striking chart when I saw the first version. I took a picture and sent it to a number of colleagues. This is a great illustration of how dramatically the industry has indeed shifted. And I think it does speak to the fact that the political dynamics are having a real impact on investment decisions. Just the reversal of flows into Asia versus flows out of Asia has been pretty extraordinary. And I think it's also leading to shifts down the supply chain too. That chart is focused on semiconductors, but of course, most semiconductors sit next to other electronic components, printed circuit boards, displays, are assembled into phones and servers. And you do see, I think, shifts in investment patterns in those components as well, lagging semiconductors, but following them in a meaningful way. And so, for example, if you look at AI chips, which because of all this FDI will be increasingly produced in the United States, you're also going to have AI servers that those chips are assembled into. And there's FDI following those server assembly facilities as well. And so the FDI that we've looked at is a leading indicator, both of future trade, but also of other FDI that follows in the supply chain.
If I could come in on that, reading the report, I was very struck, and it sort of goes from Chris's point, is that once you get the investment, you get the ecosystem that gets built around it and all the other skills and so forth. If we look at why China dominates the solar panel export market, it's not only the companies that make the panels, but it's the whole ecosystem of suppliers around them that they have made very efficient and that they, can keep driving down the costs of. And so obviously, much else grows around these things as that investment gets made. I suppose the question about the U.S. is our own skill set as a country, the ability, do we have the craftspeople to build all of this, and how fast it will happen. When here's now, for instance, when it comes to data centers, some of the data centers builders are saying huge shortage of electricians in the United States. Where do you find the electricians? It's almost a follow-on from this study is, well, what are the economic impacts of the kind of shift that you've so vividly analyzed and described?
And not to mention the skills, the workers, but also not to mention things like the building equipment that's actually necessary to build huge data centers or huge
fabs. If I can just give one example of that, is that you may say we're going to move, defense production or other production back to the United States or production, but it turns out that the equipment you need actually comes from Switzerland, in a crucial thing where there happens to be a very high tariff. So it's not a quiet river in which one is swimming.
So a question we've talked about history and what one can learn from history. Dan, Chris, or you Vivek, if for you anything pops out, can you think of examples in the past where people were taught the hard way the necessity of having either the human capital or the supplies necessary to make their foreign direct investments, their cross-border investments come to fruition?
Well, my view would be that the scale of investments shifts that we're seeing are in a lot of ways quite positive, but I also think we should have some caution about our ability to digest all of the new investment that's coming, as Dan was alluding to, and I think that's related to the second big shift that Dan mentioned at the outset, the shift from market to state driving some of these investment decisions. And here too, there are some good reasons why states are getting much more active in shaping investment decisions, but I think they also should be cautious as well in recognizing their limits, particularly on these questions of how much investment can you actually digest before costs go up and you face labor shortages. We've certainly seen that in the technology investments that you've highlighted, and it's taken a long time to work through them.
Yeah, if I just an example, I was thinking 15 years ago, I remember venture capitalists in Silicon Valley saying, you can't now think about an investment in a startup just in terms of the US. You also have to think about your China strategy. No one would say that today. And I think it is that obviously, had we not seen this growing tension in the world economy, that goes back 10 or 15 years that has bubbled up, particularly since about 2012 or 2014. If we were feeling relaxed geopolitically, we probably would not see the same pressures. And if we did not have the tensions around it, the same pressures that are really that dramatic reshaping of where FDI is going.
Yeah. Vivek, we've been talking about a variety of different ways, actually, that the complex ecosystem of supply chains conditions what is possible, but also knock-on implications. How does that flow through both to what you see and to what you track to think about future action?
So manufacturing supply chains will get fundamentally reshaped. And I think we're not going to see a decoupling of economies, but I think you will see supply chains evolving for different target markets. Given the size of the US, I think there will be a US supply chain that evolves for most sectors. And that will look different from what companies and industries do for other parts of the world. So that's the first big theme that I think we will see evolve. And I don't know where the dust will settle there, but it's very clear that some version of today's economics with tariffs built in are going to have to be baked into new supply chains targeting the US consumer. The second, I think, is the entire development of the AI industry is what's driving chips and semiconductors and the energy sector that goes around it. That's going to involve a new ecosystem developing. And companies are making big bets in that. And I think and banks, including us, are figuring out how we support them through that. I'm not sure all of it will be east into west. I think we'll see a lot of development in the east, where investment projects have been discussed but not committed to yet. So we will see big projects emerging in the ASEAN region, in the Middle East, and so on, which we haven't seen yet. And it's interesting, I'd be keen to hear from Chris on the industry seems to be developing quite distinctly in China and the US in terms of the whole AI semiconductor space. You have two very different mindsets and very different ecosystems developing. And whether that follows the same model of manufacturing going in different directions depending on where the target demand is.
Well, it's a key question, and I think one of the facets of the semiconductor chart that we saw was the drying up of FDI into China, but that was replaced in a very major way by the increase in domestic investment in semiconductor manufacturing in China. And that does speak to a sort of bifurcation that we're seeing in certain parts of the tech supply chain, with a China-focused supply chain that's mostly domestic, insofar as that's technologically possible. And right now it's not yet possible, but it's increasingly possible as Chinese firms get better and better, and a US-focused supply chain that includes Taiwan and includes South Korea, but is first and foremost focused on supplying end consumers in the United States. And so I do think for tech supply chains, bifurcation into two not wholly separate, but relatively distinct spheres is the direction of travel. And I think the investment charts show that as a leading indicator.
So Chris, going back to your own work, previous work on Russia and the West and so forth, and Soviet Union and China, if you restrict exports, that certainly signals to the other side that that's where they need to put resources to compensate for that. And so are you restraining them, or are we actually creating more intense competitors in a way that were not there before by dividing or breaking those supply chains?
Well, this is a key analytical question, and it's a hard one to answer with certainty because it depends on knowing the counterfactual. Had there been no political restrictions, what would the result have been? I guess my sense is that all the evidence seems to suggest that the drive to intensifying domestic investment in the Chinese tech sector has been a major impulse for the last 10 to 15 years. It's been enduring across a whole range of political and geopolitical shocks. And so it seems implausible to me to suggest that a couple of relatively small policy changes on the Western side would have meaningfully changed this long-term and enduring push for self-sufficiency in China's tech sector. And I think this And to your point earlier, which is that FDI has always been politically controversial, and I think China's been both a great beneficiary of FDI, but also often concerned about the dependencies that it produces.
Well, I was just looking back at that quote that I had at the beginning from 1977 about threatening the autonomy of the nation state, and kind of that could be 2025 as well.
And assuming that demand travels across border in terms of demand patterns and the nature of demand equalizes across countries much easier than it did a generation ago with services, you would, to your question, Daniel, you would expect supply to evolve to meet demand. So restricting exports will facilitate new suppliers in the markets where you're restricting sales to.
Yeah.
I'm
In
getting a
other
lot
words,
of
Chris, it always may have been there, as you said, but it certainly intensifies, as Vivek says, the drive to compensate for restrictions. And it's also kind of motivating psychologically as well as politically and economically.
I'm getting a lot of very good questions, and I'm going to start trying to integrate them into the way that I ask you all things. So all of this said, Vivek, you mentioned the potential future role of services. We're talking about what demand might evolve to be. Haven't so much explicitly said the words AI. How much of all of this is, and we talked about geopolitics as a driver, right, of shifts. We haven't really explicitly talked about what the role of AI and its progression is.
A great question, Olivia. A great question, but I know it's directed to Vivek, but I was thinking that we haven't talked about.
Anybody can answer it. Anybody can answer it.
No, I was just thinking that obviously this whole new technology is accelerated, but I turn it over to Vivek and Chris.
No, I suspect we'll all be in quite a lot of agreement here, which is a lot of this is driven by AI, right? I mean, if you just look at the commitments made, just NVIDIA and OpenAI have committed to 10 gigawatts of capacity. And I was in Dubai not that long ago in Jeongmin, I know you're there. 10 gigawatts is what Dubai utilizes the peak of summer. Right? So, and the infrastructure that goes around it with AI servers and then the renewables and the energy sector that goes around it, a lot of this FDI and a lot of the investment commitments are driven by that. But we shouldn't ignore the 45% of FDI that's still linked to manufacturing and operations. That number is what reshapes the majority of corporate enterprise because that's where the supply chains tend to be the longest and the most complex.
Chris, Dan?
When it comes to the technology FDI, I think one of the facets that has made it easier for governments to intervene in investment flows is that they're intervening in a similar direction that private capital already wants to go. Governments want more capacity, but so too do the world's largest tech companies. And so long as there's alignment between those two goals, the risk of overcapacity, which one would often assume could result in the case of government encouraged investments, right now doesn't seem to be on the table. And indeed, if you listen to most of the leaders of big US or Chinese tech firms, they're still concerned about undercapacity rather than overcapacity for these key inputs to AI data centers.
One thing that I do notice, and Vivek sort of already said it in terms of the power needs, the CEO of, I think, Amazon has said electricity is the single greatest constraint on AI, that you have industry, what used to be called big tech, now called the hyperscalers. It's Silicon Valley meets Houston, if I could put it in an American context, because for tech, software is something engineers can develop in a couple of months. An engineer in an energy industry who's building an electric power generating thing is talking about 5 or 7 years. And that is a real constraint right now in terms of the speed with which people want to proceed on AI. And that's maybe the single number one reason for the rebirth of this intense interest in nuclear power. It's the reason that natural gas is coming back into electric generation in a way that wouldn't have been expected. And it's a sort of, can you hurry up and get me the power I need? Because I'm in a race, an AI race here.
And then do you anticipate that it will in fact be a binding constraint?
I think it is a constraint. I mean, because you have permitting, just how long it takes to get the power facilities. I think it's a reasonable concern. And as it is, at least in the US, there are projections from the kind of agencies that regulate our regional grids that we run into real pressure on our power system in the next couple of years. But I could see that it's a scramble for these two industries to come together, two industries that have very different timeframes.
Daniel, do you see regulations changing in that context? We talk about regulations and data, but is the regulations on power that's going to come in, or do you see that?
Well, I think it's an issue. Permitting is this huge problem in many countries, in Europe, the U.S., and I think solving that is it's not easy. There's much desire to do that, but it's been hard to do it. But I think as we could see, if it becomes more acute, we could see an effort to really cut through the obstacles. But you're back to supply chains. And by the way, some of the things, somebody was telling me the other day to get a transformer, it was 2 years, now it's 5 years. And then that goes back to the supply chains we're issue about, because they still have components or elements that come from countries that in the US are called foreign entities of concern. So it's kind of the supply chain issues and the regulatory issues kind of get mixed up together.
So in terms of the basic resources that are needed and effectively upstream, the basic resources needed upstream, minerals and mining is clearly a real point as well. So we were talking about actually before the session. Thoughts on that? And it's also a longer timescale thing. Thoughts on that?
Well, yeah, that's one that we're working on, a study called Copper in the Age of AI. And it takes a major copper mine to come online 17 years. You need a lot of copper for this ecosystem, both around energy transition and around data centers. So there's this real concern about, will you have the minerals? And certainly we haven't really, I don't think we've mentioned the words rare earths. It's much smaller markets, but absolutely critical. And we've seen, again, kind of unprecedented, sort of like Disraeli investing in the Suez Canal. We've seen the US government investing in a number of mining projects, trying to jumpstart them, and also recognizing that you have to work with other countries on it. You can't solve it in the US alone. I'll say just on the permitting, the average mine in the United States, it takes 29 years to go from discovery to first production.
And that might be one of the big reasons why we don't see any move towards deglobalization, because it's not going to be practically feasible to decouple and move towards local value supply chains. It's just not an option in most industries.
Yeah. And, in terms of minerals, China's position is that it dominates the processing, 90% of rare earths, about 50% of copper. It's quite complicated to build, these processing facilities, and China has a cost advantage. So right now I'm here in Washington, where the question is, what are the economics of actually rebuilding the supply chains, and how quickly can you do that, or at least mitigate them? I would say there's a sense in Washington for the last 6 months on this issue, almost a crisis mentality.
So there's a mentality, if you had to make a bet, this is a sort of, but over or under 20 years, that's something that, do you actually get a reconfiguration? Or when will we know, maybe? Do we get a real reconfiguration in the way that stuff is taken out of the ground? Or maybe a different question could be, when will we know if we're actually on a plausible path to a true reconfiguration?
Well, I think it's really just it's a beginning, and this is an area, I think Xi Jinping has said that China wanted to kind of dominate the new industrial supply chains. And it turns out mining, which is not a new activity, is part of those. I mean, because take copper, it's the metal of electrification. You can't electrify without copper. So I think that this is a challenging area, and I think it's something that's on the minds of many governments, and it's changing the economics and value of mining companies.
Olivia, I'd say we know we're on the path to reconfiguring supply chains and the mineral value chain. When we get there is a tougher question, but whether we're going to move away from where we are today, I would say with probability 1.
Yeah, I think that's I mean, you just look at the spate of announcements coming that going back to the commanding heights of governments stepping in to take ownership in mining companies. Who certainly 5 years ago, no one would have expected that in the United States.
Well, I
But
think
I
that the
think you
question,
have to, if I'd say it's hard, these supply chain, it's still supply chains, they're still international supply chains. So it's going to require just as Vivek said, a reconfiguration of that.
well, and to me, the key question is both how long, but also how far will we go with these changes? Dan, you mentioned China's got a 90% processing share in rare earths, but 50% in copper. How much is too much is a question that I think governments are asking themselves. It would seem to be hard to argue that any country should completely control their entire copper supply chain from mine to processing for 100% of the copper they consume. Not much justification for that, but not wanting to be too dependent on one country is a reasonable policy goal. And so that gets back to the question of how far this reshaping is actually going to go. And I guess I would posit that governmental tools are often powerful, but the economy is very large. Trade flows are very large. And so governments can only achieve major impact in areas where they really devote focus and resources.
Yeah, well, let me ask Vivek sort of a question that follows this or an idea. And maybe and you too, Chris, when people started to worry about these supply chains over the last few years, my sense at least is there really was very little understanding of how complex the supply chains are.
I mean, the average company perversely doesn't know who's in their supply chain. Right. So you might know you obviously know your tier 1 supplier, you might nominate a tier 2 supplier, but further upstream, there's no visibility into who's and arguably supply chains have evolved to minimize costs, and lack of transparency and bad sustainability practices, you would argue, are one of the consequences of that. So transparency in the supply chains is hopefully one of the benefits coming out of all of this disruption, because transparency will also drive better practices in sustainability, whether it's labor or environmental.
But Vivek, I think that probably some of the people on the call, particularly those in Europe, would say the EU's efforts to do that with their CS3D regulation, what it's going to do is promote the deindustrialization of Europe and drive companies out of Europe, because it's, at least that's what I hear a lot.
Well, I think this is the balance, though. It's one thing to say you want to reshape supply chains, but if, as Vivek has argued, supply chains are based on efficiency as their primary driver, how much inefficiency are you willing to pay for? And in certain spheres, you're entirely justified, I think, in paying for inefficiency. But I think we have to be careful to not to move too far in the opposite direction.
No, Chris, but this is also where if you have a pain point of 20% tariffs versus lower tariffs, you can tolerate up to 20% inefficiency effectively to avoid the scenario that tariffs are working towards. So that's where I think you now have a different economic dynamic that corporates and effectively supply chains are working through.
Yeah, that's a very, Vivek, that's a very interesting way to, yeah, that what the tariff does is give you a wider realm in which to operate. But Chris, as we're talking, I mean, if you look at the book, that terrific book you wrote on the chip wars, at what point, if you will look back on the pages, did the start to become alarmed about the supply chains? 2017, 2019, or 2021?
Yeah, I think it was building in the late 2010s, but it was really the COVID shocks and then all of the second order effects of COVID, like semiconductor shortages in the auto industry, that really brought this issue front and center to most boards of directors and CEOs. But I would also say, I think it's striking the extent to which the rare earth magnet shortages that were experienced this spring also caused auto industry disruptions. If we'd fully moved from just in time to just in case, as I often hear, we wouldn't have had disruptions this spring. And so I think that does speak to the enduring importance of efficiency in company decision making, even if they're probably too focused on efficiency in spheres like rare earth magnets.
Well, when you hear a CEO say we can operate for another week and a half, it tells you that there's a high degree of urgency.
Yes, indeed.
I was talking to a procurement officer who said for the first time in his 25-year career, he's been invited to join boardroom meetings to talk about inventory.
Exactly.
And so, I mean, you would have, even during COVID, you had resilience as an issue because access to supply was an issue, but now it's much more strategic in terms of investment decisions you're making and where you take your company.
Well, Vivek, that example that you give exactly dramatizes going from, supply chains being way down there as an issue to they become a strategic issue. One area in which we haven't talked about, we've been talking about chips, but it looks like another area in which it's really coming is in terms of pharmaceuticals.
Yes.
Absolutely. So I'm going to start shifting a little more heavily to audience questions now, since we're nearing the tail end. But let's just keep the conversation going. Somebody asks, to what degree, and Dan, I think in the first instance, this for you, to what degree is the energy transition a driving factor in these trends? A lot, a little, not at all?
I would have said more a year or two ago, but I think there's a recognition now that the energy transition is kind of in trouble and it's not happening. We really are more in an era of energy addition. And now it's particularly clear in the US. Europe now has to choose between what it does on energy transition as opposed to spending more money on defense and worrying about competitiveness. I think it clearly loomed most largely, I think, in terms of batteries, would be the kind of the number one issue in which energy transition issues loomed. I'd have to think more about it, but that jumps out as and again, it gets us into efficiency, scale of operations, size of your research versus higher costs elsewhere. So, but when we looked at copper, it was clear that there you would have a big increase in copper demand because of that. An electric car is 2.5 times more copper than a conventional, or 2.7 times more copper than a conventional car.
So somebody asks, well, let me actually add something from our research and then a question. A lot of the increase in announced FDI in the broad category of energy in 2022 and 2023 was investments into large-scale green hydrogen projects. When we track whether those have even started, the answer is, for the big ones, no. Do you think that there's any reason to believe that there'll be impetus to get those started in the near term?
No, I think that green hydrogen, it will continue. I was just with a company that has a large, relatively large green hydrogen, but generally that kind of excitement about hydrogen that existed 2 years ago has to considerable degree dissipated. There's still a commitment to it, but the hydrogen-ready natural gas turbines will probably burn natural gas longer. People have just said, where's the demand? Where's the market? And, is it going to be created? And it doesn't seem to be the priority that it was 2 years ago when it was top of mind. What's replaced it is, of course, the amount of investment. And there's one area where you talk about in the study, the FDI that's going into U.S. LNG from other countries. And those numbers are very large.
Indeed. Yeah, indeed, in certain places. Tiago mentioned a few of them, but perhaps some real corridor shifts. So another question coming in, and, Chris, Vivek, actually, I'll pause for a second. Either of you want to add on that, or I'll keep going. So another question that's come in is, what about countries or regions that want to increase their FDI? So a real investment attraction question. And in particular, in the case of sub-Saharan Africa, the question is, how could it become a bigger dot on the chart that Tiago showed of flows? Any hope? What needs to happen?
Well, I think we've seen two main strategies that have been employed to increase attractiveness of investment. One is to subsidize. We've seen that in energy technologies with chips, certainly. And the other is to restrict market access unless you've got domestic production, which is what the tariffs are trying to do in the United States. And both of those are quite costly. first for the government budget, second for companies and consumers. And so there are definite trade-offs involved. And I think many governments have looked at investment subsidies in particular and said, that looks pretty attractive, but we just don't have the fiscal space to undertake those types of support measures. And so that will be a constraining factor for many governments, and already has been in terms of the ability to subsidize new FDI.
Well, sorry, go on, Daniel.
Go ahead, Vivek, please.
I was going to just add one quick point to Chris' thing, which is certainty around the regulatory regime is probably the one big factor to attract FDI into many of these new markets.
And let me add exactly that. And then the other element is reasonable financial terms. That I was just on a conversation with a mining group yesterday where they were talking about some African governments simply do not understand that they're not competitive. People can decide where to put capital. And the term that I had not heard before, they're sterilizing resources, mining resources that will not be developed because the government's terms are just not competitive. And I think one of the challenges, and we see it going back and forth, is governments realizing that they have to compete for foreign investment.
So a question has just come in about chickens and eggs. Geopolitics drives FDI. On the other hand, and historically, certainly FDI drives geopolitics. Which came first, the chicken or the egg?
Well, I think we're seeing a test case right now of FDI driving geopolitics. You know, if some of the biggest flows of FDI were from Western multinationals into China, that has not been nearly as powerful a political lever, either on Chinese policy or on US policy, as one might have thought. And so for better or for worse, I think we're seeing governments play a big role in reshaping FDI flows in ways that many corporate leaders probably would not have welcomed or designed.
Yeah, I was going to say, we are living through a period where actually we're seeing geopolitics drive FDI a lot. Obviously, the underlying themes is driven by tech developments, but geopolitics have never been more important in reshaping where investment decisions are made and what supply chains look like.
So you all spend a lot of time talking to, advising, or making decisions on behalf of your own firms about strategies. And so the question this person asks is, how can companies de-risk their FDI strategies, given everything that we've been talking about?
Well, I think Vivek's anecdote about bringing procurement and supply chain decisions up to the boardroom is a key first step. For a long time, I think many companies were in that situation of seeing these issues as secondary. Now they're seen to be both primary in their importance and also key to company strategies going forward. And so having executive attention and board level attention is, I think, quite critical.
There's a line in your report, which I quite like: when others dig for gold, sell shovels.
Yes.
I think one of the way you de-risk FDI decisions is by doing stuff that's going to stand the test of multiple scenarios in respect to where things develop. And that's one of the options that companies can take, but also just focusing on where demand is. At the end of the day, all FDI, all trade is supply trying to meet demand. So if you figure out what demand is going to look like and place your bets accordingly, that's probably the easiest way to de-risk. And obviously talk to HSBC, we can help you. I felt I had to put that plug in, apologies.
Yeah. I think that also, there's not a good answer to that, actually. The risk is there. The world changes in ways that you don't expect. What was the consensus now in 3 years is a different consensus. But I think trying to be very sensitive to the political and social currents and, as you say, using scenarios and just trying to think down the road is very important, because obviously these are some of the most important, some of the largest decisions that corporate decision makers will ever make in their careers.
And there's a wall of CapEx waiting to be deployed. Right? So yes, we've talked about tech-driven FDI and everything that goes with it, but there's still a wall of CapEx waiting to be deployed as companies wait to figure out where the dust finally settles.
But there is opportunity. There is some opportunity there. I'm going to do something dangerous, a lightning round, hopefully a sentence from each of you. On your behalf, as you're looking to think about where FDI may be shifting, what's the one thing you're looking at?
I'll go
Okay.
first. I think Dan was right to start us off with the ability of countries to actually digest and provide the labor and the components and the land and the permitting needed for FDI. This is the key limiting factor that will shape the next generation of FDI flows.
Vivek?
I think consumption will drive the next generation of FDI flows.
So I think, I was in the Middle East when those countries were pledging very large sums of money to investment in the US, and we've seen those sums. But I think I would go back to what Chris was saying and summarize in one word: execution.
With that, Dan, Vivek, Chris, thank you so much for joining. Thanks everybody for being on and listening to us. You can access our report using the short link that you can see on the screen. We'll put it right up, or scan the QR code, and we'll also share a replay of this with all registrants. And it'll also be on our MGI webpage in the coming day. We also ask for feedback at the end. We'd love it if you can take the time to send us just a little bit of input on today's session. Again, everybody, thank you so much.
Thank you.